Once again, welcome to this session. This is Deepa Sachanandani, and in today's session, we'll be discussing about the massive bloodbath on Wall Street and other markets across the globe. And of course, the main question that everybody is looking forward to is that if this is an opportunity to enter the markets or we should wait. And can we see some more corrections as well? That is all we will be discussing in today's session. But before we take things forward, I would like you to answer one of the questions which will make it easier for me to take the session forward. So I really need you to let me know your understanding of the financial markets. So that will make things much more easier going forward. So either you are a beginner, you are an intermediate, or you are an advanced level. Like, what's your understanding? You've already been a part of the market since long. You have been investing, or it's just the basic knowledge that you have about markets. From the poll that I see over here, most of us are between beginner and intermediate level. So, well, yes, we'll take the session forward accordingly. I really request you all to, be open with your questions. If there's anything, if you require any clarifications, it's feel free to stop me in between. And as and when, in fact, when I see those questions, I will answer, or maybe towards the end of the webinar, or even after the session. Whatever questions, please keep floating. It's better that we make it live and interactive. And yes, let's get started. And so, what we've seen on the markets is that there has been significant correction in many of the big stocks. If I were to name them, we've seen Netflix that has fell like almost 73%. We have Nvidia, we have Airbnb. These are some of the names that we come across on a day-to-day basis. Starbucks stock is down literally like more than 40% from its highest. You have Tesla again, that has been a stock market favorite, which is down by almost 40%. You have Amazon, which is again down by a huge 40% from its all-time high. And we have Microsoft, Apple trading at more than 20% discounts from their highs. So when you look at corrections like these in the market, and when you have such quality names which are trading at such steep discounts, the question that comes to everyone's mind is that should we enter the markets, and or do we see more correction and should we wait? So that is what we'll be tackling. And it's not only, of course, stock markets are a part of indices as well as stocks. So when you look at some of the major indices across the globe, we have the S&P 500. So this is the benchmark index in the United States, which is tracking 500 largest companies in the US. So this index is down by almost 17%. The low was close to 20%. Nasdaq, one of the tech-heavy indices in the US, is down by almost 30% from its highs. Russell, even across the globe, you have European indices which are trading at close to 14-15% lower from their top. Now, indices are nothing but they're made up of stocks. So if you club 10 stocks together, that's how we get an index. So most of these indices are trading at significant discounts as well. So before we understand that, should we invest or is this an opportunity in the market, we need to understand what were the factors that were responsible for this kind of a sell-off. What contributed to this sell-off in the market? Firstly, I mean, I don't know if you've come across this, but there were many people who were already speaking right since the start that stock markets have rallied significantly, and most of the stocks were trading at extremely high valuations. So, what happened in the markets back in 2020 and 2021? It was a lot of money that was pumped in by the Federal Reserve and the governments across the globe, which was driving the momentum in the stock. So there was a lot of liquidity in the markets, which had taken stock prices to very high valuations. So firstly, stocks were already trading at very high multiples, and they were due for a correction since a long time. markets were waiting for a pullback. Then, to make things complicate further, we had the geopolitical tensions between Russia and Ukraine. I mean, the situation is still bad out there, and all our sympathy and prayers for the people dealing with the consequences. But thanks to that, we've seen another hit to the markets, more so in the form of inflation. So the biggest problem and the most important factor that has been responsible for the sell-off in the markets has been inflation. So already, because of the massive money that was pumped into the system, we had seen inflation, reaching sky highs. It was at 40 years high. So inflation is basically nothing that when you pump in so much money into the system, and so there's so much money chasing few goods, that is what leads to inflation. So that's exactly what happened in 2020 and 2021, because the governments and central banks pumped in so much money to fight the pandemic driven crisis. So that has led to soaring prices. Then to top it up, we had Russia-Ukraine crisis. Now, nobody was aware back then, but Russia is contributing to almost, I mean, is a part of almost every other commodity. You name it, like you have oil, you have wheat, you have corn. So energy prices and food and other commodity prices went up to the roof, which aggravated to the inflation. You already had supply chain bottlenecks because of the pandemic, which was causing, again, supply chain issues, which was leading to higher prices. And then recently we had China's zero COVID policy, wherein China again went into strict lockdown, and because of which there were further supply issues that led to further higher prices. And another problem recently that the world has been dealing with is severe and adverse weather conditions. So even when it comes to India or countries across the globe, there is a talk of heat wave, because of which, again, it's destroying the crop, and because of that, we have high prices. So all in all, because of inflation, now that is the biggest problem in the room. And to tackle inflation, it is the U.S. Federal Reserve and the U.S. central banks and banks, the central banks across the globe, who have started taking measures to control inflation. Now, one of the major measures that central banks resort to is that they start increasing the interest rates. Now, when they do that, obviously the borrowing cost for companies shoots up, and for consumers also, when you're receiving higher interest rates, you choose to invest your money than spend. So automatically there is less money supply in the system, and that's how inflation gradually comes under control. So I mean, the Federal Reserve has also started pulling back money from the system. I mean, previously it was pumping money into the system. Now it is pulling back that money from the system. So all of that has, resulted in tighter liquidity conditions. And most of the stocks are generally valued based on, I mean, especially the tech stocks are valued based on the yields, on the interest rates. So the higher the interest rates, that would lead to a fall in stock prices. And that's exactly what has happened in the markets. As and when the borrowing costs for companies will increase, obviously that's a negative sign that will hit their profitability. And that's how we see stock prices falling. So as I said, the Fed has turned extremely hawkish, because of which we have seen the treasury yields, that is the yields on the bonds, that is the interest rates, basically, that has gone up to the roof. And because of which, markets are fearing that there would be a slowdown in the economy, the GDP will come down, and we will have recession. So all of this, all in all, you have inflation is soaring, the stock markets have been tumbling, consumers overall have been worrying that what will happen in the future, and that has led to the crash in markets. So obviously none of this has been good for the markets, but there has been a lot of worry and fear that seems to be already priced into the markets, and it's time that we tap the brakes a little on the anxieties and start seeing at the good sides as well. So recently, we had the GDP of US for the first quarter, which came in negative at 1.4%. So obviously, when you see the GDP fall by 1%, that's not a very good sign. But what we need to understand is that when the GDP came out negative, it was primarily on account of the fact that there were more imports, which obviously shows that there is a more growth in consumer spending and business activity and business investments, which is in fact a factor which will lead to higher GDP in the long run. So on and all, although the GDP came out negative for the first quarter, but when you dig deeper into it, it was not that bad. Now, secondly, when we all talk about recession, the definition of recession is just that when you will see two consecutive quarters of negative growth. That's just two quarters. So in 2020, also we were in a recession, but stocks reacted so quickly and bounced back up so quickly. So if there is already one quarter of negative GDP, all it needs is another quarter to achieve the definition of recession. But in fact, once we're, the fear of recession is what causes the stocks to tumble. But once we're through recession, that's the time when stocks actually start rallying. So the fear is a bit overdone. I'm not saying that it's not going to be bad for the economy. Of course, if your GDP is declining, that is a negative thing. And generally, when the Fed goes ahead with rate hikes, we do see a slowdown in the economy. But in the long run, automatically, it's a part and parcel of the system. It's an economic cycle. So we see things coming back to track in the longer run. Now, even when it comes to the big banks on the Wall Street, so most of them, like you have Goldman Sachs, you have Deutsche Bank, most of them are predicting a 1 in 3%, a 1 out of 3 chance of recession. That means they're pricing in almost 33% chance of recession. So when that's already being priced in by the market, so if that doesn't happen, it's obviously going to be a good thing. Now, on the other hand, although banks are predicting a 33% chance of recession, when we look at one of the most reliable factors that the New York Federal Reserve Bank uses, so they look at the difference between what you receive on your 10 years in the interest rates and the 3 month interest rate. So when this yield turns negative, that is when they foresee or forecast a recession. So, like you can see it on the chart over here, in 2020, the probability of recession had gone, significantly high. We had almost a 40% chance of recession. But right now, that probability is just 3.7%. So obviously, there's some amount of good news out there, uh, and less of worry and fear. Now, even when it comes to recession, so if we do see a recession like we've seen in the past, okay, so from 2000 onwards till 2020, SPX, I mean, has made a gain of, I mean, till 2022, May 2022, SPX has given a gain of 173%. And this is despite it facing 3 recessions during this period. So, on and all, if you see when you're investing from a long term perspective, the recession seems to be just a mere bump in the road. So, imagine even for investors who had invested during the peak in 2008, markets actually have given significant returns since then as well. So, overall, these are just mere bumps in the road. And when you look at it from a long term perspective, it is when there is extreme fear in the markets during these situations. People who invest during these times are the ones who tend to gain in the longer run. So, like Warren Buffett says, that you need to be greedy when others are fearful, and fearful when others are greedy. So, it's not that everything is rosy. Obviously, there is a lot to worry about in the market. So it's not that we will see a straight road ahead and things will be really. You can see the same momentum that you saw back in 2020. That's not going to happen. But when it comes when you're investing from a long term perspective, it is times like these wherein you end up getting better averages than the other times in the markets. So we'll come back to this point again and talk about it. But moving on, if we were to look at what are the other good signs in the market, things that which are positive apart from the negatives that we've already seen so far. So, although the GDP did shrink, but our labor market is still really alive and kicking. We had the US economy added 428,000 jobs in the month of April. So, obviously, that's been a positive. Even when you look at the unemployment rate, that has gradually declined from the April 2020 high, and it's near the lowest. So, unemployment rates have been low. Your average hourly earnings have been increasing. Of course, it's not as fast as your cost of living and inflation currently, but we have decent growth in when it comes to your wages, when it comes to there's a lot of jobs available in the market, and even when it comes to your unemployment rates. So overall, the labor market is still depicting, a positive side to the markets. Now, when it comes to earnings, another good factor. So we have been, I mean, markets have crashed miserably, but so far, almost 87% of SPX 500 have reported their earnings, and out of those, 79% have reported EPS above the estimates. So that's higher than the previous average, 5-year average of 77%. So that is definitely a good sign. And companies are still making money at a healthy clip, registering a 9% profit gain in the first quarter on an average. Of course, the earnings estimate, the surprise in the earnings has been only around 5%, which has been below the historical average of close to 9%. So that is slightly lower, but despite the fact that there are so many negatives in the markets and the Federal Reserve has started increasing the interest rates, we see that companies have been reporting positive earnings. Now, let's tackle the biggest problem in the room, which is inflation. So, we everybody is talking about crazy inflation numbers. We've seen almost 8.3% inflation, which is at almost a 40-year high. So that is obviously a sign of worry. But the good part out here is that previously in March, inflation rose at 8.5%. So now this number is down to 8.3% in April. So it's ending a streak of seven straight gains in the annual rate. So that is a positive sign. So the Labor Department actually showed the CPI grew by 0.3% in April, which is the smallest gain since August last year. So of course that's a positive sign. Even when you compare it to March, the number was 1.2%. So 0.3% is much smaller comparatively. So that is a positive sign, and maybe it is a sign that inflation may start peaking out. So that is one thing that can be viewed as positively. Now, the other factors that can help control inflation is the fact that previously the government, so we have seen a lot of shortage in the labor market. So the US Federal Reserve had actually given so much money back then in 2020 and 2021 to tackle the pandemic. So there were many people who were not even returning back to the workforce. So that was in fact creating labor shortages, and as a result, um, contributing to inflation. So hopefully that problem will come under control. Secondly, the base effect obviously was much lower when you see your inflation numbers today compared to 2020. So in 2020, prices had crashed. There was no inflation for that matter. So obviously, when you compare your numbers, the base number is so low that today's number looks very high. So as and when the base will start increasing, automatically inflation numbers will also look much smaller, which will again be a positive sign. And secondly, now we have, when it comes to China, that who was adopting a strict, COVID policy. Now they have started relaxing their rules, and in fact, Shanghai has not reported any cases for almost 3 consecutive days, which has been a positive sign. They have, opened up all the supermarkets, malls, restaurants, and so on and so forth. So as and when China reopens its economy, obviously the supply side issues and the supply chain related issues could get tackled, and hopefully the situation should start improving, and we could see, inflation coming under control. Hopefully, we're hoping that. And in fact, many market participants and Wall Street experts have been saying that maybe inflation has started to ease. Of course, it's not going to be an easy way out there, but inflation has started showing signs of easing, which is again a positive sign for markets. Now, so one way that we are all aware that there is inflation, and inflation has been a problem for markets. But one way to tackle inflation has been like through the stock market. So data basically is suggesting that higher than usual inflation doesn't generally have a material impact on equity returns. So if you look at the median adjusted returns for US stocks over the 2 years period following, periods of very high inflation, it is identical to the 2 year return of periods following lower inflation. So, when we have high inflation, the number for the next 2 years has been 18.5% for the US stocks. Whereas when we have low inflation, the number has been 18.7%. So the difference is hardly anything. And secondly, if you look at, so if back in 1926 till 2020, you would have needed your $100 to grow up to $1,500 to tackle inflation. So, to deal with inflation, your $100 would need it to grow to $1,500. But if you would have invested those $100 in the stock market, especially in the US stock markets, that same $100 would have actually grown to $45,000. So it is clearly beating inflation by a huge, huge, huge margin. So stocks have always been one of the ways that, which can help offset inflation and grow your wealth and preserve your wealth, in fact. So, but that's from a long term perspective always. Now, another positive factor for the markets recently, yesterday we had the retail sales data, which came in positive. So for the fourth consecutive month, we had. The retail sales, which continued to increase, which is basically suggesting that the U.S. consumer is standing firm in the face of inflation. They have been able to make purchases despite the pace of inflation. So maybe they are financing their purchases through credit cards borrowing, or maybe it is the wage growth that has helped them. But overall, the retail sales number has come out positive, which again just restores some faith in the US economy that maybe recession fears are extremely overdone. Obviously, nobody can predict what's going to happen in the future, but the data was definitely viewed in positive light. So, we've spoken now about the U.S. economy, and I've already given you a brief highlight of what the U.S. Federal Reserve has done. But just to mention once again, they've already increased their interest rates by 75 basis points this year, and they are on track to increase it again by 50 basis points at each of the next two meetings. So. That has already been discounted by the markets. They've already started reducing their balance sheet, and they've disclosed how they will be doing that. So they will be pulling back money from the markets by selling 60 billion of treasury bonds and 35 billion of mortgage-backed bonds. So when they're selling bonds, obviously they're pulling back the money from the markets. So all of that has already begun, and in fact, markets are already pricing in 100% probability of a minimum 2.5 to 2.75% interest rate by 2020, by the end of 2022. So what we can see by this, like if I were to even show you this chart out here, so there is a minimum, chance. Bare minimum that markets are looking at is 250 to 275 basis points of rate hike. Uh, Beyond that, in fact, there is a 75% probability that we will see a 2.75% interest rate by the end of the year. We're currently at 75 basis point. The target rate is basically between 75 to 100, and markets are forecasting another 75% probability that the interest rate will be at 300 basis points by the end of the year. So, what this basically tells us is that most of the negative news has already been priced in by the markets. One of the key things that we need to understand when it comes to the stock markets is that they generally react in advance. Yeah, and this was even confirmed by Fed Chair Jerome Powell in his speech yesterday. Even if you look back at the past, it can be like the year 2020. Stock markets rallied like crazy, and that was a year when companies were in fact reporting losses. There were no sales, nothing was happening, but markets reacted well in advance because they could foresee the amount of money that the Fed was pumping into the system. They could So markets react well in advance. They could foresee that eventually the pandemic will fade out, and the kind of profits that the companies will actually make in the future, and they could foresee that this is a short-term phenomena. So when that happened, markets reacted well in advance, and they did not give time to so many people who actually missed out, on the rally in the markets and could not participate in the same. So that's exactly what is happening right now. Also, although the Fed has not increased the interest rates, but markets have already priced in. So there is already 100% probability that the interest rates will be at 2.5 or 300 basis points at the end of the year. So that has already been priced in the markets. Beyond this, if the Fed actually does anything lower than that, it will actually be a big positive for the markets. And when it comes to investing in the markets, if we start investing actually when inflation is under control, or when inflation starts coming down, by that time most of the stocks will actually already rally. So at that minute, it could you anybody would miss out on majority of the gains. So that's the whole idea and funda of stock markets, that it reacts well in advance, and that is what we need to understand and capitalize on. Now, even if I were to show you the now one of the major factors that has been responsible for the fall in the markets, like I have stated in the beginning slides as well, is the surge in the treasury yields. When I say yields, is basically the interest rates in the market. So if we look at this, the benchmark 10-year treasury yield actually had fallen drastically in 2020, because the central banks had cut the interest rates, and now they are back up to their 2018 levels. That is the pre-COVID levels also. So the markets have priced in almost all the negative factors, all the rate hikes have for now looks like to be priced in, and there is a lot of resistance out here, like we can see. So the yields have not been able to, in fact, the yields went up to as high as 3.2%, and then they fell below that. So it is highly, I mean, it looks like from the chart that they will face a lot of resistance over here, and will probably start sliding down from here and not move higher. If that happens, that is obviously a positive sign for the markets. Now, apart from that, when it comes to the treasury yields, they basically move inversely to bond prices. So if bond prices will go up, yields will go down, and if yields go up, bond prices go down. That's how it works. Now, so what is happening is currently the 10-year yield is at 2.95%. whereas the 10-year annual average annual inflation is expected to be around 2.59%. So obviously, you're currently receiving more than the inflation rate. So it is, a favorable scenario for investors to invest in the bond market. So when they start investing in the bonds, gradually the demand for bonds will go up, bond prices will go higher, and that's when the yields will start coming down. So that's how it works, and probably the yields for now seem to have topped. Same story can be seen for the 2-year treasury yield as well. It is nothing but the 2-year interest rates in the US, and they are already at 2.7%, which means markets are already, I mean, the Federal Reserve has not even increased the interest rates to that level, but the 2-year treasury yield is already yielding 2.7%. So that itself shows that most of the negative news seems to be priced in for now. And like we can see again, there is a lot of resistance around these levels, and most likely the yields could start sliding down, which can be positive for the markets in the long run. Now, again, so whatever I say out here, of course, this is a general overview that I have been sharing with you all. But it's important that we understand that for everyone, it's very important that they consult with their investment consultants before they decide to invest in the markets, because for every individual, their goal, their risk, and the other factors vary. So it's important that you have a one-on-one discussion either with me or with your consultants before you invest in the markets. So this is just a general overview, but the risk factors keep varying from individual to individual. Now, also, as we can see, this is the volatility index. Now, volatility index is basically a measure of fear. Now, whenever there's a lot of fear in the markets, this index shoots up, and at the same time, simultaneously, we'll see the stock market crash. So it basically works inversely to the market. So as we can see, because of obviously the downfall that we, of course, the biggest spike that you can see on the chart over here has been in the year 2020, and that was because obviously it was a COVID situation that nobody had ever seen in the past. So that is why the volatility index shot up to those high levels. But otherwise, in the past, wherever we've seen, it's generally the volatility index faces resistance from 30 levels, 30 to 40 levels, and generally it retreats back downwards from those levels. So right now also the volatility index made a high of 33, and it has fallen back from there. So overall, what we can see is that whenever the index goes up to that range, generally it pulls back, and it's basically a sign of, like, the fear. It's a measure of fear in the market, which starts coming down, and automatically, on the other hand, we see the indices or the stock markets end up doing well as and when the volatility index comes down. So again, this index is also kind of giving a similar picture that maybe the sell-off was overdone. Maybe there's a lot of excess fear in the market, and that has started coming down. Obviously, but nobody in today's markets can predict the exact low. And in fact, not only in today's markets, generally overall, the basic rule of stock markets has been that it's actually futile to try and time the bottom. Nobody can exactly time the bottom. So what in fact we need to understand is that this is a time wherein cash heavy investors can start buying, but obviously in phases. You cannot go in all out. And of course, it's not that things will not get much worse from here. They can, but it is stocks are something that can make even buyers who overpay look a bit wiser when it comes to the long run. So as and when time passes by, in fact, even if you end up buying stocks which are slightly overvalued, that may end up being a good decision when you see in the long run. So the S&P 500 is an index which is already down in terms of its valuations. It was trading at 21 times its earnings, and now it is down to almost 17 times. And whenever someone has invested, when the price earnings ratio has been close to 17 times, we've seen that, and if that person has held it for a period of 10 years, so the returns around have been close to mid to high single digit returns. So of course now you will tell me that inflation is already at 8.3%. So even if SPX is giving us 8 to 9% annualized returns, how is that any good? Because inflation is already at 8 to 9%. But you have to understand that this number is not the current. I mean, it's a backwardation. It's a backward-looking number. Going forward, inflation is expected to come down because the Federal Reserve has already started deploying its tools. In fact, the average 5-year inflation is expected at 2.9%, whereas for the 10-year, like I said previously, it's expected at almost 2.6%. So it is at times like this when investors start investing that actually in the long run, your average returns in SPX turn out to be much higher than if you would invest during the peaks. So on an average, for any person who's been investing in SPX since the year, say, 1988, the average return has been 10.6%. So, in the long run, the annualized return for SPX is definitely positive. Of course, when we see the Federal Reserve raise interest rates and tackle inflation, that could be a negative sign for the economy. We could see a recession, but the good part is for now the jobs are abundant, wages have been rising, and the household corporate balance sheets are also looking very strong. So on and on overall, when it comes to markets, this could be your first level of entry when we start averaging into the stock markets. But again, this is the answer to this. I mean, whether you should be investing or not in markets will obviously depend on your duration of investments. If you're looking at an immediate return, that may not be possible. We will not see the kind of massive returns that we saw in the year 2020, 2021. But in fact, when you look at it from a long-term perspective, these are the years where when you start investing, where in the long run, your returns tend to be much better. Like I said, Warren Buffett says it that when there's a lot of fear in the market, that's when you need to be greedy and start entering. So generally, people just feel that okay, it's the end of the year, things are going to crash miserably, but that's generally something that never happens, especially when everybody is predicting it. So when everybody is talking about a recession, or when everybody is talking about a stock market crash, generally what we've seen in the past. That doesn't really happen because markets cannot be so easily predicted. Back in, I mean, when everybody is talking that markets are going to rally, that is when you suddenly expect a crash. That's all about that. That is all what markets are. Nobody can exactly predict what's going to happen next. But one advice that I can clearly give you is, for the momentum chasers who've been sitting on fallen meme stocks like you have EMC and many others, it's time we probably exit these stocks or stop definitely stop adding on to these stocks right now, and there's no point in doubling down on these stocks. Probably you could even think of removing your money from these stocks. On the other hand, you can look out for established companies with strong balance sheets, and there are many good deals available out there in the market. So those are the companies that you need to be shifting your funds into. Don't look for meme stocks. That is something that will not do well in these markets. So that is where we need to shift our focus. So quickly, just to get an idea as to how we can invest in these markets, I've already shared a lot. But one thumb rule that we can follow when it comes to these markets is that we do not need to use leverage. These are markets which will be volatile. So, if you're investing in these markets without leverage, then I can say we will most likely be safe and there's nothing to worry about from a long term perspective. But if we're investing in these markets with leverage, then obviously there is a sign of worrying fear because you cannot predict what's going to come next. So in these markets, in such volatile markets, definitely leverage is a no. Now, apart from that, if you stick to the, in fact, before I share these numbers, I think it would be nice if we could just do a small poll once again. So I don't know if y'all have heard about, I'm sure y'all have heard about this. It's something called as the SIP form of investments, wherein it's like a systematic investment planning where every month you invest, or every year, or every quarter, you invest a fixed amount in the markets. So, just to understand, according to y'all, if we invested $1,000 in SPX every month in a form of SIP based investment, starting since the year 1988, according to you, what would that amount grow to? I'll just start the poll. Yes. So, do you think it would grow up to 500,000? Do you think it would grow up to 1.5 million or 2.2 million? Or do you think it would grow up to 3.2 million? So, what do you think? Basically, the total investment would have been close to approximately 400,000, somewhere there. That would be your investment. So, what do you think the value would grow up to? So we have so far 50% who are going for $1.5 million. Dollars. Okay. We have 30% who actually think it could be even $3.2 million. And we have almost 17% who think it could be 2.2. Okay, now that's 13. And we have someone who thinks it could have grown up to $500,000. So, yes, all right. So the maximum votes that we have received is for 1.5 million. So we have 56% who thinks that it would have grown up to 1.5 million dollars, and we have 22% who think it would have grown to 3.2 million dollars. So as you can see, the correct answer is 3.2 million dollars. Yes, a basic. I mean, your total investment for these many years would have been around 400,000, which would have actually grown to $3.25 million. Like, it's a plain and simple strategy every month, irrespective of the markets. And in fact, it is during these falls that when one invests, that the average turns out to be much better. So the biggest advantage of SIP form of investing is that you don't need to think, and you don't need to analyze that is this the bottom, will markets crash further, will it rally further, all of those questions are, you need to completely ignore them and every month regularly invest in the index, and the returns and the numbers are right here in front of you. If we look at the investment since the year 1990. So why 1988? Because the dividend data for SPX is available on Bloomberg since the year 1988. Of course, the numbers would have been even better if I were to look at it from the year, for the years beyond 1988. So if I look at it from 1992, the investment would be 365,000, and the return, the final value as of today's date, would have been close to $2 million. So just understand, a gap of merely 4 years would have resulted in a difference of almost $1.2 million. So, and I mean, your investment amount is less by just $50,000. So that is what we do not want to miss in markets like these. So a regular SIP is something that is always recommended, and one should stick to this form of investments. Over the years, if you can see the last for someone who even invested during 2002, basic 245,000 would have grown up to almost 900,000. In the last 10 years, your money would have more than doubled. So SIP is one way that will help you fight inflation, and it's like one of the easiest and the simplest forms of investment, a hassle-free form of investment, wherein you don't need to think as to you don't need to take that decision. Whether markets will fall further, or do we need to invest further? Because many a times when we end up doing that, you end up missing out on the opportunity. We had so many clients who actually missed participating in the rally back in 2020. So because most people were of the opinion that markets would crash and so on and so forth. But these are markets; they never react in a way that most people are predicting. So, in fact, mostly they react opposite to what people think will happen. So. That is about markets. Now, another way that we can be invested in these markets is by using like one was a systematic investment plan. Apart from that, we can look at investments in phases. So we I will be covering this in detail in our next webinar. But for now, what we can understand is that we'll be investing in the markets in phases. So in the first phase, we'll invest 20%. In the second phase, we'll invest 35%. And in the fourth phase, we'll invest 45%. So that's how our investments will be. We will not invest everything upfront, and gradually we'll keep increasing our investments. So that's how we'll go forward when it comes to investments in these kind of markets. So what happens is that when you invest in markets in this form, you get to capitalize on any further dips that can happen in the foreseeable future, because the biggest issue right now is in predicting the bottom. So we don't know if this is the bottom or if there is a further downfall. But at the same time, we have to realize that Amazon is available at a 40% discount. Same goes for big other big names out there. So when you have such big names, it's very common to see that when Amazon is rallying, most people are cribbing that, oh my God, we missed out on the rally. But and everybody is promising that when it comes down, I'm definitely going to buy. But when the stock starts falling, that's when everybody starts panicking and is like, okay, this is going to be the end of it all, and nobody wants to invest back then. But these are the times where you need to slowly and gradually start entering the markets, because that is what eventually plays out in the long run. Again, please understand all of this works in the long run. When we talk from a short term perspective, the markets are going to be very volatile, and that could be nobody can predict what would happen next. But from a long term perspective, investments like these, especially in phases and blue chip stocks, generally should be a great idea from a long term perspective. So, this portfolio we've divided into aggressive, moderate, and conservative. So, what happens is that as an aggressive stocks are the ones which tend to move much faster than the markets. So, if markets will fall, aggressive stocks may fall much more. Moderate stocks tend to fall in line with the markets, or they rally also in line with the markets. And conservatives, their movement is generally lesser than the markets. So what happens is when the markets start recovering, we'll see the aggressives will outperform the average benchmark S&P 500 index. So in our aggressive stocks, we've considered all of these are blue chip names. So you have names like Amazon, Alphabet, Tesla, Salesforce, Marriott, Delta Airlines. In fact, we've seen a lot of trend which has been shifting towards the travel and the service sector. So markets are forecasting a lot of demand to come in the service sector, especially in the travel area. People now enjoy spending more on experiences than on items. So that is one area where we can see growth in the future. So which is why we have names like Marriott International, Delta Airlines in the portfolio. Apart from that, we also have names like Royal Dutch Shell. So what will happen is that if if oil prices keep rising, you need something that is a hedge against the same, and which is why companies like Royal Dutch Shell. Of course, I don't need to mention about the likes of Microsoft, iPhones, Apple. In fact, 1 billion people own an iPhone out of the population of almost 7 billion. So that's the number that Apple has. So keeping that in mind, these are companies that will eventually end up doing good in the long run. And of course, we have the conservative stocks out here. Now, these are stocks which are generally considered as defensive stocks, which help you ride through in case if there is a downfall or a correction in the market. So these are companies. These are basically utility and staple stocks, which people end up buying the products irrespective of a slowdown in the economy, because that is something you cannot do without. So these companies will generally end up doing well even if there's a slowdown or a recession in the economy. So overall, on the year-to-date basis, like Coca-Cola, Kroger, these stocks have actually given positive returns for the year compared to other stocks which have in fact declined drastically. So this is a portfolio that we have prepared recently. You can take a look at it. Your RMs can share these portfolios with you. And in case if you have any doubts, in fact, we will be taking up an entire session on these portfolios as well. So if you have any doubts or anything, you can always reach out to us. Go through these stocks and let us know your takeaway on the same. But these most of these are blue chip companies. We are even planning to come out with some of the other growth names out there which have been beaten down drastically. But we're looking for companies which have sound business and potential to grow in the future. So we are working on that, and that shall be available shortly. So in the meantime, these are the blue chip stocks, which these are quality names which can allow you to participate in the markets. Apart from that, we can look at index ladder portfolio. So this is like if you are not interested in individual stocks, then you invest directly in the indices, which is generally considered a more safer approach because the entire index will not definitely not crash. Stocks end up being more volatile than indices. So it's a very balanced and mixed approach that we've considered when it comes to these indices. Of course, majority of the weight will be given to United States because it is the leading, even in terms of market cap. So that is one market that cannot be ignored. Apart from that, we have given exposure to Europe, to UK, to Canada, and Japan. Now, if I were to if I don't know if you noticed if I were to take you back to the first slide wherein we actually saw the performance of major indices this year. If you can see, we had UK 100, which is actually down only 3% from its 52-week high this year, compared to other indices which are down by 17 to 15 to 20%. Now the reason behind the same is that UK consists of a lot of energy and defensive and value stocks, which have helped the index do well this year. So even if you look at Canada 60, which has a lot of energy companies, which is obviously, I mean, I don't need to tell you about how well energy stocks or oil prices have done in the current year, because of which oil prices, energy companies have been doing well. So we have Canada 60, we have UK 100, we even have Switzerland, which is again a defensive index, which is dropped much lesser than the other indices, and it is a way to invest in the current market. So when you're investing in these markets, it's very important that we consider a diversified approach, and that is what we have been handling or tackling in all of our major portfolios. So if you look at this, we would have, like I said, 47% would be invested in the United States, 33% in Europe. Then we have an exposure to UK, Canada, as well as Japan. So it's like a diversified approach that we are considering. Apart from that, other ways that you can participate in the markets, we have some market neutral strategies, which I would be covering in the upcoming webinars. Now these are basically, when I say market neutral, they do not have anything to do with the direction of the markets. They are just focusing on a particular spread or a price difference between two assets. So even if the markets go up or go down, if your view about those two commodities were correct, um, generally you end up making profits. So it's a market neutral strategy which has nothing to do with the direction of the markets. So that is one way that we can participate in the markets, which obviously I said we shall be covering in great detail in the next session. And then we have something about an overall asset allocation or a portfolio allocation. Like if you have to invest right now in the markets, how do you invest? How do you go about? So, like I said, 50% of our allocation would be towards the blue chip ladder portfolio and the index ladder portfolio. Now, of this 50%, obviously we'll be investing only 20% in the phase one. So that means only 10% will be invested of this 50, like of the entire 100%. So the remaining 40% will remain as cash, and we'll wait for further dips or entry levels in the markets, if any. The remaining 15% we would allocate to the market neutral strategies that I just spoke about, which we will be covering in our next session. The remaining 10% will go to growth stocks, because the majority of the growth stocks have fallen significantly. Again, we will be releasing a portfolio of growth stocks as well. This would primarily focus on companies which have sound business, but we need to understand when it comes to growth stocks, they are obviously risky. In fact, most of the growth stocks this year have fallen drastically. Like the numbers have been almost 60, 70, or 80% also for some of the stocks. So we would be looking at quality names, and because of the steep fall, probably from a long-term perspective, these could be good investment bets. But because they are aggressive, so we invest only a small proportion, that is 10%. Then we'll invest the remaining will be basically a way to deal with inflation and to hedge against the market risk. So commodities, for example, wheat and corn, there is a massive shortage, and that has been shooting to the roof. So, one way to tackle inflation, which is the biggest problem, would be if we invest in commodities. So, that will provide a hedge against your portfolio. Bonds are also a good option. So, 10% would be allocated to that, whereas the remaining 15% will be allocating to energy stocks and to defensive stocks. Again, defensive stocks are the ones that tend to do well, irrespective of. These are companies whose products are in demand irrespective of the cycle of the economy. So most likely, in case if there is any slowdown or a recession in the markets, these stocks tend to do well. So which is why it like you can see, almost 25% is something that we are investing in assets which will actually be a hedge in case if we have recession or any kind of slowdown. So that is how we are looking to invest in the current market situation. In case, of course, if you have any questions, we are happy to answer. Okay. Yes, I do have a question. Um, So someone has asked that where do we stand right now? Did we have we reached the base, or do you expect another red wave coming to the markets? For now, at least in the immediate term, it seems like we have reached a base. At least in the immediate terms, that is what the technical charts and the markets and the signals are predicting for now. Because most of the negative news seems to be priced in. We have to wait for incoming data when it comes to inflation figures. That will be a key factor that we need to monitor going forward, because we need to see how the inflation numbers come in the next 2 months based on the rate hikes that the Federal Reserve has already taken. So for now, in terms of when it comes to the charts, it seems like probably 3,800 levels for the SPX 3860 has is a decent entry level. At least for now, that seems to be the case. Now, moving forward, usually stock prices are reflecting companies' performance. Is this the fair value of companies like Amazon or Tesla? Certainly, of course, for when it comes to Tesla, it is generally overvalued when it comes to Tesla. So it is, of course, whenever you look at the average median target price for a company like Tesla by most of the analysts at Bloomberg, generally the target price will be low than the current market price. That's how it works for Tesla, because it is Elon Musk who has actually driven the company to those levels. So it is more of one of those favorite stocks and the market darling that has helped Tesla reach those highs. Of course, but if I look at it from its valuations, a few months back, currently it is almost at a 45% discount. So if you consider from that perspective, of course, this is a much better value for Tesla. But again, Tesla is something that is more than its fundamentals. You will have Elon Musk and his tweets that will be driving the stock price. For Amazon, yes, it is certainly. I mean, their AWS and their overall cloud computing business has been doing really well, so it can be a decent opportunity from a long-term perspective. All right, so someone has asked, thank you for the information. Can we get a copy of the slides? Yes, certainly, that will be done. And for beginners or a guy who would start investing in the US stock market, do you think starting with options is a good idea, or what would be the right strategy to start or recommend with? The options is something, I mean, that would definitely not be recommended for someone who is a beginner. It would be wise if you start with an SIP form of investment or go for a ladder based approach. That is something that would be a wise strategy to start with in the markets, and then gradually we can move forward to options, which can be a good way to even hedge your portfolio. But the as a beginner, it is important that you understand the movement in the markets, and at least start participating in the stock markets either through the stocks or through indices, and then gradually move on to options. So the right strategy would be to to wait and understand the markets before you get into options. And there is also a question for Sharia stocks. What is your source of clarifying this share of company is fully Sharia? So there are websites. I mean, there is a company which is actually responsible for for providing the data, which is also certified by Bloomberg. If the stock is Sharia compliant, so we refer to that company before we. And there's a filter available on Bloomberg as well. And only based on that criteria, we shortlist the stocks. Only if they meet the requirements, the stocks, Shire stocks, have been shortlisted based on those requirements. So I hope I have answered all your questions. In case if there are any more questions, please feel free to ask. We'll just wait for some time. If not, then we'll wrap the session. But like I said, I mean, I would just like to wrap it up on one particular point, is that when it comes to financial markets, trying to time the bottom is really futile. We need to start for especially for cash heavy investors. of course, once you consult with your investment consultants, or it depends on your financial situation and on your risk appetite and your investment goals. But it is opportunities like these wherein one needs to start entering and gradually averaging out in the markets, which will eventually provide better returns in the long run. So that is the approach. Would like to end it with the fact that which is really true and applicable in these markets: be greedy when others are fearful, and fearful when others are greedy. So that is it for today's session. Could you please, there's a question, could you please repeat the answer for the first question? Right, so the question was, do we see, there is obviously a lot of volatility in the markets. Have we reached a base or a resistivity point, or do we expect another red wave? So the answer, like I said, most of the negative news for now seems to be priced in. Markets have already priced in 50 basis point rate hikes for each of the two next meetings, and in fact, there is a 100% probability of interest rates at 2.5% at the end of the year. So almost all the negative news for now. I mean, everybody is aware of the kind of inflation that we are seeing in the market. So for now, the negative news seems to be priced in. An important factor that we will need to consider and monitor is the inflation data. So going forward, if inflation still doesn't come under control, despite the rate hikes, and if we see a further, a lockdown or crazy situation in China, then it could be a problem. But for now, the data that is available, and looking at the technical charts, maybe it seems like we've made a base out here, at least for the immediate future, because China has, relaxed its zero COVID policy, which is a major positive. Because of that, we may start seeing supply chain issues ease, which will actually tackle inflation, and which will actually, probably even lower the probability of rate hikes. So also, if there is further slowdown in growth, for now we were not expecting the Fed to change its rate hike policy. So luckily, I mean, thankfully, all the numbers in terms of retail sales, even the jobs report, has come out positive. So that in the long run, in fact, if we see the numbers start coming lower than expected, maybe the Federal Reserve even will alter its rate hike plans, and that is what Fed Chair Jerome Powell indirectly hinted in the markets yesterday. So, of course, in the next two meetings, they're sticking to their 50 basis point rate hikes. But beyond that, if they see inflation is coming under control, then maybe we do not see the same pace, and all of that would suggest that markets could rebound. So, but by the time, in fact, once inflation starts coming down, in fact, that by that time it would be too late to invest, because markets would have already rallied. So, to answer your question again, have we reached a base? For now, it seems like in the immediate term, probably yes, 3860 for SPX. Even according to their PEBD band, the price band, and the 10-year average PE band for SPX was at 3860, the exact level from where SPX bounced back. So, and for the immediate term, it does seem to have created a base at 3860. All right, then. I thank you all for this session. I hope it was useful and informative. In case if you have any questions, if you want a one-on-one session, I'm available, or we even have our consultants available for you all. So you can always reach out to us, and please feel free to review us as well on Google as well. Thank you very much once again.